In this video, I'm going to talk about the capital asset pricing model, or CAPM. So the basic idea behind this is we're trying to come up with an equation that connects risk and return. And having an equation that actually directly connects risk and return is practically the holy grail of finance. And the basic idea underlying this particular model, so it's the capital asset pricing model, is that basically since diversifiable risk can be eliminated through diversification. So, and if you're wondering about that, go back to my prior video about diversification. But since diversifiable risk can be eliminated through diversification, this model is assuming that we've already done that. So we're assuming that we have a diversified portfolio that has eliminated the diversifiable risk. So I don't have to worry about diversifiable risk at all. All I'm thinking about is the systematic risk then. So the diversifiable risk is gone. So what that means then is that when I'm looking at a portfolio, because I should have a portfolio and it should be well diversified. I don't actually care about risk of an investment by itself. So in other words, I don't care about standalone risk. So I've got 1,000 stocks in my portfolio. I don't care about how risky one of those stocks is all by itself. The reason I don't care about that is I don't have one stock by itself. I have 1,000. So if I have 1,000 stocks in the portfolio, I don't care about how that one stock looks all by itself. I care about the portfolio. And so what that means is what I do care about for one stock is what impact does it have on the whole portfolio. So the impact of an individual investment upon the portfolio is what is going to matter, because we're assuming we've got a portfolio that's well diversified. So I don't care about any stock by itself. I don't care about any bond by itself. I don't care about any investment all by itself. I care about what does this particular investment do to the portfolio. That's what I care about. Now, as it turns out, there's a measure for this. So beta is going to be our measure of the contribution an investment makes to the systematic risk of the most diversified portfolio. Now, the most diversified portfolio we can come up with is if we just invested in everything, and that would be the market portfolio. So that's the idea behind the market portfolio. I've invested in everything. Beta is measuring the contribution an individual investment makes to a portfolio consisting of everything. So in other words, well, how much risk does this particular investment add to my portfolio of everything? And whatever impact it has on the risk of everything, my everything portfolio or my market portfolio, that's beta. Now, if you're wondering, well, like, okay, so if that's what it is, like, how do we calculate this? What is it? Basically, beta is related to the covariance between the investment relative to the market. Now, if you're thinking, covariances. Have we seen covariances before? Absolutely. If you go back to my video about risk, what you'll see is that it's all about covariances or correlations between investments that dictate risk. So in this case, what I'm looking at is the covariance between a particular investment or the returns of the investment and the returns on the market or most diversified portfolio as a whole. So I take that covariance and I divide it by the market's variance, and that's beta. So beta is basically capturing what impact does this individual investment have upon the risk of my entire portfolio. Now, once I have beta, we can put it into a formula. That's where we get this capital asset pricing model, or CAPM equation. So this is a model that connects return and my measure of the contribution that an investment makes to the riskiness of the portfolio. So RI is the return on the investment. RRF is the risk-free rate. The ERM is the expected return on the market. I have the risk-free rate again, and then I have beta. So let's look at a couple of examples here. Let's suppose that my risk-free rate is 5%. My expected return on the market is 10%, and I've got a beta of 1. Okay, so a beta of 1 basically means that the covariance of the return relative to the market is exactly the same as the market's variance. So what that means is basically when I add this stock with a beta of 1 to my completely market portfolio, diversified portfolio, then basically it's going to have the same exposure to systematic risk. It's not going to shift the systematic risk exposure to my portfolio at all. So if I take the expected return on the market of 10% in my little example, minus the 5% risk-free rate I specified, 10 minus 5 is 5. 5 times a beta of 1 would be 5. 5 plus 5 would be 10. So that would say that if my beta is 1, the market has an expected return of 10, the risk-free is 5. I would expect this particular stock, it needs to provide me with a rate of return of 10, which is the same as the market. And the reason why that's the same as the market is because this thing had a beta of 1, which means it had the same systematic risk exposure to the market. So when I added this stock or investment to my completely diversified portfolio, it didn't affect the systematic risk exposure I had. So I basically just said, I just need to get the same level of return that I'm getting on the market portfolio overall. And I specified that was 10. Well, what if beta was 2? If beta is 2, that basically means it has essentially like twice the systematic risk exposure. That's kind of the idea. So a lot more systematic risk exposure than my diversified portfolio. This is going to add a lot more systematic risk exposure. Well, in that case, I'm going to take if the market rate is 10, 10 minus 5, risk-free is 5. So 10 minus 5 is 5. 5 times 2 is 10. 10 plus 5 is 15. So that says that I need to get a 15% rate of return on this particular investment to compensate me for the risk that it's going to add to my diversified portfolio. So because the beta was 2, market's only offering 10%, this stock needs to get me 15% to compensate for the fact that this stock would add more risk to my diversified portfolio, or this investment would add more risk to my diversified portfolio. What if the beta is 0.5? Well, that means it actually has less systematic risk exposure than my fully diversified portfolio. So it actually has less risk to economic and fluctuations and recessions and things like that. So in that case, I would take, if my market rate's 10, my risk-free rate is 5. So 10 minus 5 is 5. 5 times 0.5 is 2.5. 2.5 plus 5 is 7.5. So I need to get a 7.5% rate of return on this particular investment to compensate me for the risk that it would have relative to my portfolio. And so basically the market, I'm getting a 10% or expecting a 10% return. But this investment, I'm okay getting 7.5 because this has much less systematic risk exposure. When I add it to my portfolio, it will actually decrease the systematic risk exposure of my entire portfolio. So I am okay getting less than the market rate of return on that because it has less exposure to those systematic risks. So I can also take that market rate minus the risk-free rate and call that something else. That's the risk premium on the market. So the risk premium on the market is the extra return above and beyond the risk-free. So if the risk-free is 5, the market's 10, we're getting an extra 5%, basically because of the systematic risk associated with the market. So the risk premium of the market is the extra return above and beyond the risk-free. So if the risk-free is here, market is expected to be here. That extra return is because investing in the whole diversified market portfolio of everything involves risk exposures that the risk-free investment does not. Hopefully this video has been helpful. Thank you so much for watching and have a great day.